Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities. And one of the things we do in January is we focus on what the leadership is in the market and make sure that we have some exposure to what's going to lead the market the rest of the year. One sector that we have identified that we think is too undervalued and is a nice defensive area to be, plus it provides a hedge in the portfolio if inflation would come back, is the energy sector. And we're going to talk about that as we initiate a new position in that sector last week. So the stock market to start with. The stock market's valuations are getting up there again with a little bit of an increase in the appreciation of the stock market this year. It's selling at roughly close to 20 times earnings at 19.7 times 2024 earnings. And what's happened is the earnings expectations, both for 2023 and 2024, have come down a little bit. So the earnings expectations were $246 this year, 2024. Now they're down to $243. So if you take out the COVID distortion in the PE multiples, because the earnings all just collapsed during COVID, and so it had the PEs much higher than what they were if you normalize them. But if you look at the PE multiples kind of over the last 10 years, the market tires out, the PE expansion tires out around 18 to 20 times earnings. You can see that the last three times it got close to 20 times, and then 19, and then 18 and change, and then the PEs recessed. So we are concerned that the market valuation is high, that the issue in the market is not the inflation, but it's the rate that the inflation will come down because of the market's expectations. The market's expecting 6 rate cuts in 2024. We think that's nonsensical. That's not going to happen unless we go into a recession. 3 rate cuts is more likely what the Fed kind of guided to. So much different in terms of the rates declining to keeping the economy growing at a reasonable rate. We think 1% or less or into a recession is the likely growth rate of the economy in 2024, which will be difficult to support that $243 in earnings estimates. So it's really important to find the groups of the market, the groups in the market that will outperform, that have good earnings trends, and that are attractively valued. So the inflation report last week, it was a little higher than expected at 3.4 versus 3.2 the previous month. So 3.4 year over year versus 3.2 the previous month. So it ticked up a little bit. You can see a little tick up right there on the chart on the right-hand side. So it ticked up a little bit. We were wondering if we're kind of stuck in that 3% range or if we will actually come down to 2%. There's some reasons why it should recede down to 2% due to housing prices coming down. But as the 10-year Treasury has come down so much in price, it gives some support to housing prices. So maybe that's not going to happen. Maybe we're stuck in that 3% range. But what's been helping inflation is the U.S. energy inflation has come down in a major way. This is what's been driving the inflation lower, not negative, but just lower in terms of growth, is that the U.S. inflation rates was big time negative in the middle of the year last year. And as we go through this year, those comparisons are going to be a little more positive for the rate of inflation for energy. So as we hit the May, June, July period, any sort of positive trend in energy is going to look really good because energy prices are down quite a bit. That key component of energy is something we're a little bit concerned about. We think by owning energy, it's a great hedge against energy going up. And we're a little concerned about what's going on in the Middle East in terms of supply disruptions occurring because of that. Now, we did initiate a position in energy. We haven't had that position in a long time. 2022 for energy stocks was great. 2023 was horrible. Roughly the last 12 months, energy stocks have underperformed the S&P by 28%. So that's large. We think the price of oil is bottoming. And so this is the futures price of a barrel of oil at roughly $72. We think that 70 holds for multiple reasons, but we think that 70 holds. It's starting to break above the 20-day moving average, and that's the initial signs that we may be forming an uptrend in the price of oil. We'll have to watch that closely. And then the XLE, which is the energy ETF, it too looks like it's found the bottom. So you can see here that it's hit this level a few times and bounced off of it. So around $81, $82 a barrel. So $81 or $82 for XLE seems to be an attractive area to enter this position. As we go through the year, we think there's all sorts of reasons to own this, particularly the heightened risk of what's going on in the Middle East. Supply and demand, they seem to be in balance, but you never can tell what may happen with that. And then the inventory seem to be tricking down some, so that's a positive aspect as well. So we like the XLE, we like Chevron, there's Schlumberger, there's a number of names in the energy sector that we like a lot. They all seem to trade together, so buying an XLE makes a lot of sense in the portfolio and get that inflation protection into your portfolio. It's very underowned sector of the market. Valuations look attractive. It's underperformed a lot, so it's kind of run through the ringer, right? It's kind of washed out, and any sort of positive news could make this sector market go up quite a bit. So where's the leadership in the overall market? We follow this pretty closely, and we follow it because what tends to outperform early in the year tends to follow through the rest of the year. So right now, the healthcare sector is leading the way. It's up over 3% year to date. It's been the strongest performing sector in the overall market. The market itself has some defensiveness to it. So the areas of the market that are performing are the ones that are more recession resistant. So the healthcare sector is outperforming for good reasons. There's good fundamentals. The valuations are cheap. The earnings are good. We see that the large cap companies have been really aggressive buying smaller cap biotechnology stocks or mid cap biotechnology stocks as well to fill their pipelines. The obesity drugs, that's going to play out over a long period of time. $100 billion in potential revenues annually. $100 billion annually. So that's going to drive a lot of growth in the overall sector. It's going to drive acquisitions. It's going to drive more R&D. It's going to drive more drug development. So it's a great trend. We like this sector a lot. Now things don't move in a straight line. So 3% up and the market roughly being flat. That's a nice outperformance so far for the year. Now looking at technology. Technology had a nice pop last week, up almost 5%. So it's about even year to date. It performed really well last year. So we think it's going to struggle because valuations are high. It got clobbered in 2022. So we think it's roughly back to even or higher in some circumstances. We would be cautious on the technology sector. What the markets did last week, because of the inflation report, it ran to safety. It doesn't believe that the rate cuts are going to come quickly enough. And so that's why there's a whiff of inflation in the overall market itself. And technology is perceived as being defensive. If you look at the defensive areas of the market, consumer staples, healthcare, consumer services, all doing fairly well. Now the utilities, they're down a little bit on the year as bond prices have moved back up a little bit, and for good reasons why bond prices moved back up a little bit. They moved too much to the downside in terms of yields. The cyclical sectors of the market, like consumer discretionary, industrials, energy, materials, and real estate, all very much needing the overall economy for their earnings growth. These sectors are all down year to date. So it's something to keep in mind. The markets are being defensive. They're thinking about recession a little bit, and those groups that have exposure are underperforming. So looking at the overall indexes the S&P flat, the Dow flat, NASDAQ flat. However, all the small cap stocks are underperforming. We think that the market's just being cautious. It's being defensive. That's why the small caps are not performing very well. So if the economy really starts to get going with lower interest rates at some point, the small caps are going to do very well. But we think that they're going to struggle if the market's going to start to discount a recession. So again, the bond market down a little bit. The 20-year Treasury ETF down over 2%. We think bonds are a little bit under pressure. What we would do is focus on the 1 year and less on the Treasury markets. So get a 5% yield on Treasuries. You don't need to go out in terms of maturity. Just buy the short end. So buy nice defensive sectors of the market like healthcare, consumer staples. That's how we're positioned. We like the big cap consumer companies in general. And then have money over in the shorter end of the yield curve if you need income. Thank you very much. Please hit like, come to my website, Patrick Adams CFA, sign up for Market in a Minute where you get these stats and a whole lot more commentary than what we go through on these videos. Take care.